Good morning from London. I'm Anna Edwards alongside Guy Johnson and Kriti Gupta. We're an hour away from the opening trade. Here's what you need to know. 25 or 50, former New York Fed President Bill Dudley makes the case for a half-point cut as fresh US data sustains expectations for the Fed to trim next week. Boeing's largest union says no to a deal setting up a strike involving 33,000 workers and adding another headwind for the troubled plane maker. And the US and UK discuss lifting missile restrictions for Ukraine. This as Prime Minister Keir Starmer visits the White House later today.
Meanwhile, a quick check on these markets. Green on the screen when you're looking at the futures picture. Your Stoxx 50 futures higher by 0.4%, but the FTSE underperforming just a little bit, flat at the moment. The 2 years where we're getting our attention, given potentially some pricing, some thoughts, some concerns. Maybe 50 is back on the table, as Anna was mentioning. 357 on the 2-year yield. That's going to move the dollar, euro dollar at a 110 handle. The countdown to the opening trade starts right now.
Good morning. Friday the 13th. I'm just saying, be aware of it as you think about how this day is going to progress. We are firmly focused on the Fed this morning. We saw some big moves in markets yesterday as a result of what appears to be a message maybe coming out of the Federal Reserve via the Wall Street Journal. We're all used to this kind of messaging. We've seen it in the past. Is the market set up correctly? 50 or 25, hard or soft landing. The debate goes round and round and round, but it certainly seems as if, looking at what we've seen in the equity market, the bond market, and of course gold over the last 24 hours, Anna, the market is growing nervous once again about the prospect of 50. Yeah,
absolutely. The market is, or excited at the prospect of 50.
So that's the bit that I can't figure out.
Right, depending on which market you're looking at and what dots you're joining here, I suppose. So we saw Treasuries rally, we've seen yields coming down, in particular at the short end, reflecting this renewed expectation in some parts of the market that maybe we get 50. And yes, you can look at the PCE data yesterday and say some of that clears the way to do 50 if the Fed wants to, but it wasn't all about the data. It seems there was this Wall Street Journal story that didn't have anything particularly new, but by a person that many think the Fed is very well connected to at a time when the Fed can't speak for itself. And that seemed to, and that was really setting out the case for why 50 could happen, also 25, but 50 could happen. And so that was seen by markets as perhaps a reason to keep 50 on the table.
Nick Timmerow strikes again, but I love that the title of this piece that actually kind of struck fear into the heart of the market. Start big or start small. We all know what's happening. We all know the direction of travel. What we don't know is the appropriate way to digest it. Do you start off strong and then kind of see the ripple effects, or do you do it gradually? And I think in the last 2-3 years, that's the difference, right? We've seen the market has actually been, and the economy has actually been able to handle bigger hikes at a faster pace, which has never really been happened before, maybe setting the tone for easing at the same pace.
The debate seems to be evolving around the soft landing. The idea was a few weeks back that 25 would signal a soft landing was still on the table and the Fed was comfortable with kind of the trajectory that we were on. The narrative now seems to have shifted to the idea that you need 50 to secure the soft landing, i.e. the data are deteriorating at such a rate that you need 50. You need to start strong to make sure you stick that landing.
But also, you don't want financial conditions to tighten on the back of 25. And, this is the point that Wall Street Journal article makes as well. It reminds us of something we've talked about before, that market expectations matter. And although the Fed doesn't just do what the market wants it to do, if the market is expecting, it wouldn't say so. If the market is expecting something more and it doesn't get it, then financial conditions are in danger of tightening, and that's not what the Fed will want to see.
This is the entire topic at Jackson Hole, wasn't it? The transmission mechanism. Do you still have the same timing as in previous iterations? And the answer this time seems to be no.
The labour market is absolutely front and centre in this whole debate. We saw that yesterday in claims. Let's turn to another aspect of the labour market and what is happening in the United States. Boeing's key union has voted to strike.
This is about respect. This is about addressing the past. And this is about fighting for our future. Our members rejected the contract by 94.6%.
So at around 8 a.m. UK time, midnight in Seattle, we are going to see circa 33,000 workers walk off the line and start striking. You're going to see plants all the way from California up into Washington walking off the line. I think it's 33 gates into the company's facilities are going to see strike action. The unions be preparing for it. It was a significant vote against the deal. The longest action we've seen by machinists at Boeing was in 1948, and it lasted 140 days. There's some talk that this strike could last until Thanksgiving. There's an expectation that Boeing is going to have to come back with more.
Well, this is scary as well, because we saw in the last couple of days that managers have been actually kind of walking the floors and seeing what can actually be replaced, preparing for this kind of longevity of the strikes. I think what's so important to me here, important for this region, is the ripple effects across the world, across the industries. If we're talking about potentially 140 days on the table, or potentially till Thanksgiving, not to mention the election playing into that, that's going to last a while in terms of supply chain issues, which is not music to Boeing's ears.
Yeah, yes, and all the customers for Boeing have been dealing with supply issues. You point out Ryanair, absolutely. They've been dealing with these supply issues of a different nature to do with safety, and that slowed down production already. Then you add on this. I'm interested also in what this tells us, if anything, about labour markets and where we are right now, because during that peak in inflation that we saw in many parts of the world, there was a lot of tension between labour movements and governments and employers and big business. And you might expect that as inflation has come down and many places really quite normalised, that would go away. But this is a reminder that life's not that simple.
It is. So there's a lot of history here. This has been an issue that has been building up for quite some time. Boeing is also under significant stress, so the unions feel like they have significant power. It's not a huge amount of the cost base for Boeing in terms of kind of thinking about the total cost that the company faces. And it therefore probably leads you to the conclusion that maybe Boeing could put something more on the table. It's got a new CEO, Keir, has come in. He's going to want to deal with this very quickly. So do we get back to the negotiating table? Do we get a better deal put on the table quite quickly? Boeing is going to want to get this resolved super fast, because it needs to, as Anna says, get on with dealing with the other challenges that the business faces right now.
And we should just remind our global audience, they're asking for 25% of a guaranteed wage hike over the next 4 years. And they were, of course, expecting far greater than that. They were also not getting an annual bonus. So you can see how this is all spurring to the top. We should talk about another story that's kind of top of the agenda, but perhaps now something that the markets are paying attention to, and that is the summit over in the States. It looks like Joe Biden is going to be meeting with Keir Starmer. And one of the pieces of debate is going to be how much of these long-range missiles are supplied to Ukraine that allows them to strike within Russia. This is a very controversial approach. You've seen other European kind of their counterparts pull back from that. And it's something that right off the bat, given that this is something that they're trying to do as a war strategy to kind of take off some of the pressure off that eastern flank, Vladimir Putin's already responded, saying that if these missiles are actually supplied by the United States and the UK, he would see it as war from NATO. That is a big deal.
Yeah, and specifically if they are not only supplied, but if they are given the green light to be used into Russian territory, then absolutely that's his stance, that's his position. And of course, the situation on the ground is that Russia has started a counter-offensive against what Ukraine has been doing since August, which was, it caught Russia by surprise. It took parts of the Kursk region, parts of Russian territory, and Russia caught off guard. And now actually starting that counter-offensive. And our reporting suggests that has really begun.
Is the use of Storm Shadow missiles different to using Bradley armoured personnel carriers? I think that's the question. So you've already got US kits in Russia.
Yeah, but it's to do with where they're allowed to be used. Yeah, into Russia, yeah.
So it's whether or not, if you're Russian and you're looking at this, you're thinking, how do my early warning systems react? You've got Storm Shadow missiles, which potentially can be nuclear tips.
Yeah.
Being used in my country. How should I be reacting to that? I guess this is different to the kit that is currently in operation. You're already seeing some reaction, you could argue, from the Russians. They're already kind of talking about restrictions on uranium. You've seen big reactions in some of the mining stocks overnight as a result of that. But yeah, I think it's going to be a fascinating meeting in Washington today between Keir Starmer and Joe Biden. There's also the issue of Gaza on the table as well, which I think will be an interesting aspect of this conversation too. Slightly different views being expressed by both of those two leaders.
Yeah, absolutely. 4:30 Eastern time, we see that taking place in Washington. Shall we get up to date with some of the guests we've got?
Talk about some of the guests that we're going to be talking to throughout the show. 50 or 25, Coco Agboola from SocGen is going to be joining us. We'll talk about the markets. We'll get an update on the fiscal outlook here in the UK, which apparently isn't that good. We all need to get healthier. We all need to work a little bit more. Richard Hughes for the Office of Budget Responsibility is going to be joining us. Plus, Madeleine Rona, DWS, is going to be joining us after the opening trade. We'll talk there about what is happening with this German banking story as well. Banking consolidation front and centre right now. Ralph Schloss, Evercore Chairman Emeritus, is going to be joining us. We'll talk to him. It's going to be a great conversation about the markets. We're going to talk about the US election. We're going to talk about how Harris is doing. We're going to talk about that debate. There's a lot in that conversation with Ralph. In fact, I think we're going to have two.
Yes, absolutely. Why not? Let us tell you what else is coming up on the trading agenda today. Things to watch out for. EU finance ministers are meeting in Budapest. The ECB members will be in attendance. The day after, of course, we got rate news from the ECB. We get euro area industrial production at 10 a.m. Now, this is important. The focus on the consumer in the United States comes through loudly in some of the notes I was reading ahead of our guest conversations today. Relying on the US consumer for growth. Well, in what state is it? We have US data on that front coming at 3 p.m. UK time. We will also be hearing from various speakers from the ECB, Bank of Finland Governor, the ECB President Christine Lagarde, Bundesbank President Nagel, all speaking later on today. And as we mentioned, we have that meeting between Starmer and Biden that is taking place at 9:30 then UK time. Team, let's just go on to some breaking news this morning, which is of a competitive nature within the telecom space. The UK CMA saying that the Vodafone-Three deal may raise competition concerns, specifically around mobile customers and how much they'll have to pay for their bills. They do acknowledge that the merger could improve the quality of mobile networks, but it's all about investment into the future. And so we wait, the CMA collecting more views ahead of a decision on the 7th of December. And Kriti, this is really important because the others in the sector who are not involved in this deal, it's all about what conditions are attached. If this deal is allowed to go ahead, then, what are the conditions that are attached to it that will perhaps satisfy a little more some of the other players within this market?
Yeah, Vodafone seems to be getting into the crosshairs of regulators, not just in the UK, but in Europe as well. And we should point out that in the last 24 hours as well, there is a deal with Swisscom potentially having a takeover of Vodafone Italia. And it's the same story. It is a concern around competition. It's a concern around pricing. Of course, Swisscom trying to push back, saying, look, this isn't actually better for the consumer. The regulator's not buying that.
There's been huge pushback in the UK about mid-cycle, mid-contract price increases and how those are linked to the inflation rate.
Something that the government has actually said it might look at.
Precisely. So this is part of a wider picture that I think could affect this sector in a significant way. Let's talk about some of the other things you need to know this Friday morning. First up, Pravin Gordhan, the South African leader who held 3 positions in the country's cabinet, has sadly died. Gordhan won plaudits for standing up to Jacob Zuma during his scandal-marred presidency. He was 75. In other news, Bloomberg has learned that several EU nations intend to challenge the IMF about its plan to engage with Russia on economic issues for the first time since the invasion of Ukraine. The IMF has said that it's restarting annual reviews of the Russian economy because the economic situation is more settled than before, calling it a mutual obligation. And OpenAI is releasing a new AI model capable of performing some human-like reasoning tasks, known internally as Strawberry. The company says the tool will be able to solve multi-step problems, including complicated maths and coding questions. Do I need to learn to code if this is going to do it for me?
This is a very good question. A new level of AI capability, just when we were getting ready, just when we were getting used to the last level of AI capability and asking questions about that, we have a new level here. Doesn't seem quite as ready for general consumption yet as previous iterations, but they're clearly very excited about it. I was also excited yesterday to see news that a delegation, including OpenAI and other players in the AI space and the wider tech community in the United States, were all in Washington to talk about data centers and the infrastructure and the energy requirements that all of that needs and the planning and the way that we connect energy suppliers to these power-hungry data centers. And that seems to be an issue in lots of geographies. So interesting that it's getting so much attention from the Biden administration right now.
It absolutely is. I'm wondering when the Biden administration is going to look at it and say, that's too expensive, because it's starting to feel like that's what the markets are looking at OpenAI with. You talk about the kind of the fundamentals. I'll talk about the valuations here, because those are going just off the charts when you look at what OpenAI has been, the numbers, the eye-watering funding numbers they've been looking at this week. The story that caught my eye overnight was that a French startup called Poolside, which is also specialized in AI.
Poolside?
Poolside.
It's a French strawberries and Poolside.
The AI audience
is that where it was invented?
They're having fun. I don't know. I don't have the answer to that. But they're $3 billion. They have a $3 billion valuation for coding AI, but haven't released an initial product yet. And I think it speaks this idea that the momentum isn't gone from this area.
These companies raise money, though, but they need to raise money because they have to buy NVIDIA chips. The cost of building these businesses is astronomical in terms of just the hardware you've got to have and the working capital you've got to employ. It is staggering. and how much money they're actually making off it remains an open question. So the valuation is high, but are the margins commensurate?
Right, so the barriers to entry, they're sort of Nvidia-shaped at this point.
Yeah.
Right, let's talk about some of the other things that are coming up in programming today. Coming up, the UK's official forecaster is warning that public debt will triple within 50 years. We will speak to the chair of the fiscal watchdog. That is later this hour. Plus, the latest from Seattle, as Boeing factory workers are set to walk off the job and go on strike. Up next, how much will the Fed cut when they meet next week? We will discuss the outlook for markets. If you have any questions, if you want us to put them to guests, please do get in touch. IB plus BBTV Go is the function to use this morning. This is Bloomberg.
The risks to economic growth remain tilted to the downside. Lower demand for euro area exports, owing, for instance, to a weaker world economy, or an escalation in trade tensions between major economies, would weigh on euro area growth.
And of course, Christine Lagarde, the ECB president, she navigates the threats of trade tensions and a weaker global economy. Joining us now, Coco Agboola, Global Head of Economics, Cross-Asset and Quant Research, and UK Head of Research at SocGen CIB. That's quite the business card. I'm just going to point that out. We probably could have whittled that down to one or two. Nice to see you. Are central banks behind the curve already?
Well, I don't think so. I think they are pretty much in line with the path of the glide path of inflation.
Yeah.
Because if you look at the empirical evidence, corporate profit margins are pretty strong.
Yep.
I mean, this is the greedflation story. Balance sheets have, corporates have developed a sort of immunity against higher interest rate because they've locked in low level of interest rate 5 years out.
Consumers.
So have consumers. Excess savings have been depleting gradually. So we don't have this sort of shock that would justify an aggressive cut. And if you look at the latest average hourly earnings number, they were a bit on the high side, which is a bit surprising when you think about non-farm payroll being weaker than expected. So there's still a bit of uncertainty. And last but not least, it takes 3 to 5 quarters for monetary policy to hit the economy.
Yeah.
And long end bond yields have already come in. So the sort of stimulative adjustment is already being fed through the markets.
I'm spending a lot of time thinking about this, and the conclusion I've come to is that the economy might not need aggressive rate cuts, but governments might.
Yep, that's a very good point, and this is the whole sovereign debt crisis or stress, let's say. But if you look at our expectation is that we'll see rate cuts every quarter going forward.
Yep.
So 100 basis point for the Fed and the ECB next year, 50 basis points for the Fed this year. So that's 150 basis points of cuts. So for any government budget and debt servicing, it is looking pretty good, even though you still have pressure.
Yeah,
it's getting better because it's all about this refinancing wall we have for leverage credits and private assets. The fact that you know they will be able to refinance at lower rates should give you some comfort in easing the tension you would have had otherwise.
Well, Coco, in the last 24 hours, the news that made waves was the conversation of if you're going into a cutting cycle, do you do 50 first or 25, like 50 and then 25 or 25 and then 50? And I'm curious what difference that actually makes.
Yeah, I think it's more of a signaling difference. But I think if you think about the sort of 3 to 5 quarters argument in terms of transmission mechanism, and then you know what we've seen so far, which is high economic data volatility. Like we started the year expecting 5 cuts this year. Then a few months ago, we were 0 cuts should the Fed be hiking because of the strength of non-farm payrolls. Yeah. And now we're back into cutting because we see things slowing down. So there's still a lot of uncertainty on the data, even though the glide path appears to be clear. But again, I'd like to caution the fact that corporates are still doing fine. They are under no pressure to fire people, even though small and mid caps may have a bit of an issue. But I think, we just need to be cautious. So 25 would be, from a game theory standpoint or distribution of outcome standpoint, the safer bet.
When it comes to the idea of kind of who's actually in charge of the real rates in the economy at the moment, would you argue it's still the Federal Reserve, or are the markets more in control in terms of the transmission mechanism of what we're seeing impact everyday consumers?
Yeah, it's a good question. And I think it's always a tug of war between governments and central banks and the markets. You know, if you remember the mini budget crisis in the UK and the sort of feedback loop between markets and government policy. But I do think central banks are still in charge, even though, you know, there's a question around the argument in terms of budget, sovereign debt and the pressure on central banks to cut to avoid a sovereign debt crisis. Yeah, we'll have to see, because at the end of the day, a quote that I love is that of Nassim Taleb, who said, no, make sure you're not fooled by randomness.
Yeah.
And I think we have some data randomness, and it's very important not to act or have too strong a decision from one or two data points.
OK. Koku, thinking about things that we should react to or prepare for, the US election is on the horizon.
Yep.
To what extent do you think that markets should be pricing in one or the other outcome here, given that we might not get a clean sweep in Washington, and therefore policy movement, certainly on the domestic agenda, might be restricted? The international agenda could be a different matter, but domestically?
Yeah, I think domestically it's going to be pretty tricky because, as you mentioned, it really depends on whether we have a clean sweep either way for policy to be decisive and change things. But I think the bigger element from a market's perspective will really be the path of budget deficit and sovereign debt, particularly as you can see the debt service being such a big component of the overall budget deficit. So if the path of interest rate is not adjusted quickly, the sustainability of the debt path could be a major issue. And the question will be whether we could have, to some extent, a sort of mini-budget crisis, US style, in terms of the bond vigilante starting to have less confidence and creating higher bond yield and more volatility.
And what is it that would cause us to have a Liz Truss style episode in the United States? Whose policies?
Well, that's obviously more of a Trump policies
because of the
tax cuts, more spending, etc., and making things less sustainable from a government balance perspective. But it is obviously a smaller probability, but it is something to still bear in mind.
Great to see you. Thanks for stopping by. We always appreciate it.
Thank you.
Koku, Global Head of Economics, Cross-Asset and Quant Research at SocGen. Thank you very much indeed. Let's talk a little bit about what we're getting from Boeing. So a few hours ago, we had news that its biggest union is going to strike. We are now getting an emailed statement coming through from the company. The message was clear that the tentative agreement we reached with the IAM leadership, that's the union, was not acceptable to the members. We remain committed to resetting our relationship with our employees and the union, and we are ready to get back to the table to reach a new agreement. 25% was what's on the table. The union wants significantly more, or at least its members want significantly more. What will they get? How long will it take to get it? Key questions. Kelly Ortberg, the new CEO of Boeing. We will get an update, hopefully, from Julie Johnson in Seattle very shortly. Coming up on the programme, the UK's fiscal watchdog is warning the public debt in this country could triple in the next 50 years. We are going to speak to the chair of the OBR, the Office for Budget Responsibility. That conversation is next. This is Bloomberg.
We're about 30 minutes away from the start of the opening trade. You are seeing futures in the green right now, but at the moment we are getting some headlines coming from none other than Olli Rehn, of course, the Bank of Finland governor as well, speaking a lot of what we kind of already know, saying the weakness in euro area growth is more structural than they had hoped, seeing question marks in that growth outlook, really honing in, Anna, on the idea that the ECB's inflation story still, quote, bumpy.
OK, bumpy on inflation over at the ECB. Let's bring the conversation to the UK now. The UK's official forecaster is warning that public debt could almost triple to over 270% of GDP within 50 years. Richard Hughes is chair of the UK Office for Budget Responsibility, and he joins us now. Richard, really nice to speak to you. Thanks for coming to talk to us here at Bloomberg. I'll start with the big picture then. This is a very long-term warning you've given us here. 270% of GDP in 50 years. How much agency do we have? How much power do we have to change the course of this debt profile, given some of it is pegged to ageing populations and climate change? How much would you say is up to us?
I think governments do have choices, and there are things that governments can do to affect that trajectory. As you say, one of the biggest drivers of the rise in debt over the next 50 years in our projection is just the fact you've got an aging society, fewer people in work, more people claiming the state pension, more people putting pressure on the health service. And so that means that the demographics are going against you. But there are things which governments can do. I mean, one of the things we look at in the report is if you can change the trajectory of the health of the population and keep people healthier for longer, that means they're more likely to stay in employment, they're more likely to earn more, pay more in tax, claim less in welfare, and also put less pressure on the health service as they age. And that can make a big difference to that trajectory. It could actually bend it by up to 40% of GDP by the fifth year of the forecast in a better health scenario. And then if we end up in a worse health scenario, then things look worse. But also on things like climate change, if we get to net zero, both in the UK and around the world, that can also make a difference to that trajectory. We have scenarios looking at different levels of emissions and what that means for the cost of climate change that they impose on the economy and public finances. And those can also make a material difference to the debt outlook.
OK, and you make it clear, Richard, that with that backdrop around population and demographics, that perhaps productivity is going to be part of the answer, and many other countries would say the same. When we talk to those who operate in gilt markets, sometimes they say, they get nervous in the UK context about any increase in borrowing. We've seen that evidence very clearly. Other occasions, they say, well, if you're borrowing to invest, that's different to if you're borrowing to fund day-to-day spending. What are the conversations like in Westminster with people that you talk to, Richard, about what tolerance gilt markets would have, do you think, if a UK government wanted to invest to increase productivity?
So, public investment and indeed private investment is a key input to the productivity of the UK economy as a whole. The challenge is how do you get maximum bang for your buck if you're investing publicly? And also, one of the big challenges government faces is that the payback times for investments in the economy are quite long. You've got long lags to build big infrastructure projects, and then you've got even longer lags to see their impact on the economy. We published a paper just a few weeks ago looking at empirically, what is the evidence shown as being the impact of government investment on economic output in the long run. And in the near term, it's relatively small. A 1% of GDP increase in public investment gets you only about 0.25% increase in GDP over 5 years. But if you look at over 50 years, it gets you about 2.5% return on GDP. The issue is, can governments be that patient to get that kind of return on investment? Oftentimes, chances are just looking 5 years ahead. That's the length of a parliament. That's the length of oftentimes the government's fiscal targets. And you don't see much of a return from public investment over that kind of time horizon. You do see a much bigger return, over 10, over 20, over 50 years.
Richard, good morning. It's Guy. What lessons are we learning from the United States in terms of what it is doing on the supply side? We've obviously seen over the last few years huge investments as a result of the IRA, the CHIPS Act, etc. What conclusions can we in the UK draw from that?
So if governments want to strengthen the supply potential of their economies, there are measures they can take. Even here in the UK, we saw the previous government was looking to reduce the tax burden on labour. Even in our own forecasts, we reflected some of that in terms of an expectation of higher labour supply, because people are paying less in national insurance. That affects their decisions to supply labour to the market. Also, interventions that the previous government took on childcare, we thought would have an effect on women's participation, women with young children more likely to enter the workforce so they can access lower cost childcare. So governments have choices about how they can affect the supply side. The issue is, these effects are relatively modest and they take a while to make a difference.
Does the UK government need the Bank of England to cut rates? Is there a cost of money issue here?
I think all governments are facing the squeeze on interest rates. Over our 50-year projections, if you leave the public finances, on sort of policy autopilot, what you see is interest costs growing and growing. They're already at about 4% of GDP today. By the end of the forecast period, they get up to about 12.5% of GDP. So they're the second biggest source of pressure on the public finances if you just leave things on autopilot. And it's because governments around the world have debt to GDP ratios of approaching 100%, sometimes above 100%. And so those higher interest costs are really eating into government's fiscal choices.
Richard, it's Kriti in London. I want to circle back to the climate change conversation that you talked about at the start. And speaking of this kind of story of the cost of financing, I want to talk about the prospect of greenflation, this idea that if you do start to see more and more governments around the world, the UK included, lean into this idea of addressing climate change in the long run, does that hurt the budget in the short run? And to what extent does that need to be flipped, that to address the short-term concerns, you need to roll back the focus on climate change? Is that something that's crossing your desk?
I wouldn't say there are many governments who are ahead of the curve in terms of addressing climate change. I mean, if anything, most countries are behind actually getting to their emissions targets. What we show in the report is that actually, if governments can manage to reduce the prospective damage from climate change by taking action, possibly on the investment side, possibly on the tax side, possibly on the regulatory side, governments have got a choice of instruments to choose from. If they can do that, they can reduce what can be quite serious damage to their economies and their public finances from the cost of climate change. We've seen here in the UK an increase in both the intensity and severity of flooding. That has costs for the economy. It also has costs for the public finances because it has costs for the emergency services. It has costs for government in terms of compensating households and businesses for the damage done to their properties. That can make a big difference to the public finances in the long run, and the amounts of investment that you have to do to stop it from happening is relatively modest.
Well, Richard, you mentioned that crucial piece, taxation. I'm curious how much, in terms of quantifying that hit, does that hurt things like private investment from the rest of the world?
All right, so our tax burden here in the UK has gone up by about 4 percentage points of GDP over the last 4 or 5 years. That clearly has incentives on people to want to work and invest. I'm not sure that we've seen a significant impact on foreign investment, but it certainly has effects on people's sort of day-to-day economic decisions.
Richard, given the conversation we were having a moment ago about how you require a lot of long-term thinking, perhaps, to invest in all the productivity measures that the UK economy might need, is there a danger that your forecasts are being a little too optimistic on productivity? I think you're assuming that we'll see a gradual pickup to 1.5% in the long term. Is there a sense well, how much confidence do you have around that kind of number?
So we're relatively close to the consensus these days on productivity growth, a little bit above. We aren't assuming a return to pre-financial crisis levels of productivity, but we're also not assuming that the very low levels of productivity growth that we've seen since the financial crisis persist into the future. So I think in that sense, we're kind of neither optimistic nor pessimistic about the outlook for productivity. We're somewhere in the middle and not too far from the consensus, I'd say.
Richard, thank you very much. Thanks for your time. Richard Hughes, Chair of the Office for Budget Responsibility, the OBR, here in the UK, that provides the forecast that the government does its budgets from. Let us have a look at some other breaking news. Just crossing whilst we're having that conversation with Richard, China approving a plan for the first hike to the retirement age since 1978. The plan is to gradually raise women's retirement age to 55 and then to 58. So we're getting a lot of detail about what this means. And I suppose that does tangentially fit in with the conversation we were just having about, in the UK situation, debt loads, but just the population, the financial sustainability of these models in various countries with ageing populations, and China is a fine example of that.
It absolutely is, and we should note that China's retirement age is among the world's lowest. They're having the same issues you're seeing in France and the UK. That pension reform is, of course, top of mind. It all comes down to that labor conversation, really around the world, not just in China, and that's where we continue the story, except this time over in the States. Coming up on the program, Boeing factory workers vote to go on strike. We're going to check in on the suppliers and the customers who may be impacted right here in Europe, along with your other stocks to watch ahead of the opening trade. Stick with us. This is Bloomberg.
Minutes to the opening trade. How much did we learn yesterday in Frankfurt? Well, we are learning that governing council members believe they aren't yet in a position to rule out a cut at the October meeting. Remember, at the moment, the market's kind of got priced another cut in December from the ECB. October is a very low probability event, but we're not prepared at this point to rule it out. Policymakers basically weighing a downturn in the economy. They're looking at underlying inflation projections, though, that are nudging a tick higher. Are you worried about what's happening in the rearview mirror, or are you driving the car through the windshield? Lizzie Burden joins us now from Frankfurt. Talk to us about this argument about October. It does seem as if the market is assigning a very low probability, but the ECB is not ruling it out yet.
Yeah, about a 20% probability priced in now off the back of yesterday's press conference. And just passing some of the latest ECB speak this morning, we've heard from Olli Rehn. He's emphasising the question markets with the growth outlook. Joachim Nagel saying that he does see inflation calming down. He's at the hawkish end of the spectrum, mind you. And Simkus saying that more cuts need to happen as inflation is calming down as well. But before we get too dovish here, and remember Lagarde saying that the risks to growth are tilted to the downside, but no bias mentioned on inflation. Lagarde had all the opportunity in the world at the press conference to signal that an October cut is coming or to rule it out. Remember how clearly she telegraphed that June cut, and yet she sat on the fence, and yet she said they're going meeting by meeting, it's data dependent, they're not pre-committed to a particular path. And so this is why you've got traders pairing the bets, but really sticking to what economists were seeing anyway, which is quarterly cuts of quarter points to 2.5% by this time next year.
And Lizzie, to your point, you're already seeing just less than 24 hours later after that press meeting, several of the other kind of voting members as well, Olli Rehn, one of them included among many others, already echoing that exact point. Analysts, on the other hand, saying maybe the inflation forecast may already be out of date. Are they having trouble keeping up?
Yeah, this is interesting. And one of the other notes in that ECB speak this morning is the worry about services inflation. But the reason that this might already be out of date, the inflation forecast of yesterday, is because of changes in the oil price. So they're forecasting that Brent will cost $76 a barrel in 2025, $73 a barrel in 2026. But if you look at the JP Morgan and Citi forecast, they say there is a possibility it could be $60 a barrel. And then if you plug that into Bloomberg Economic Shock Model, SHOK Go, on the terminal, they say that that would knock 0.4 percentage points off inflation this year and next in the US and Europe. So that's a very different economic backdrop against which to be policy making.
Lizzie, thanks very much. Bloomberg's Lizzie Burden on the ground for us in Frankfurt, covering that ECB meeting yesterday, and she'll be back with us next week for the Bank of England. Joining us now, our Markets Live executive editor, Mark Cudmore, to talk about the markets in 3 minutes. And we probably would need a lot more than 3 minutes to fully get to the bottom of the 25 or 50 debate that seems to still be raging, Mark, and it seems to have been reignited by, yes, maybe some data yesterday, but importantly, perhaps a Wall Street Journal article that a lot of people are talking about. What's your take?
Yeah, well, first of all, it is amazing we're seeing such volatility in the Fed blackout period when there hasn't been kind of massively consequential data. And as you say, there's that Wall Street Journal article. Some people feel that might have been directed there. We've also had Dudley come out, given an opinion piece saying he validates 50 basis points. So suddenly 50 basis points is back in play. I think what's interesting here is that the market is dovish itself. It wants to be dovish. There's enough of the market that feels that the Fed is behind the curve. I'm not one of them, but there's enough of the market that every time we get some kind of dovish reaction, we move quickly on the rate side to ease. When is the last time that you remember PPI having a bigger impact than markets than CPI, especially when both were roughly in line? And I think that shows that there is a real desire for the Fed to go 50 basis points from everyone out there. If they can get the pricing to 38 basis points priced by the time of the Fed meeting, I think they will deliver 50. I think that's that binary trigger moment. Maybe we'll get that through consumer confidence or maybe retail sales next week.
Yep. Mark, given the fact that it feels like we're in something of a relief rally right now, how will risk assets react to a 50 basis points cut from the Fed? Because the argument has been that if we get 50, that signals something is wrong. If we get 25, we are signaling that we are in a soft landing scenario.
At the moment, we're moving to the narrative that 50 is from a position of strength. It's getting at the head of the curve. Well, sorry, it's catching back up again because many people feel the Fed is behind. And therefore, I don't think there'll be a panic if there's 50. I think that'll be seen as aggressive move, but be very supportive for stocks in the short term. I will say, though, that even though we're in a relief rally at the moment, I haven't found the price action very comforting in the last couple of days, nor in the last couple of months for stocks. And I say that as someone who's still structurally bullish because I think the economy is doing fine and the Fed's dovishness will only help further. But I am still worried by the price action out there. But that said, even though the price action's worrying, 50 basis points will be a positive. It will not be seen as a panic move.
A positive in terms of the stock market, in terms of the bond market? Where does it actually show up, though, in terms of market gains?
Yeah, actually, it's a great question, Kriti, because you'd think obviously it's the bond market, and then I'm saying that the stock market is a kind of follow-on through from that easier policy. But funny enough, we've priced in such dovishness in the bond market that if we get 50 basis points there, everyone goes, oh, that's just front-loading it. It's not changing the path, especially if they do it from a position of strength. So ironically enough, that would be an easing move, which would be more supportive for the stock market if the Fed can kind of persuade people that, hey, we're getting back ahead of the curve, we're not panicking, we're just making sure that our policy is well calibrated, and that's supportive for stocks.
I mean, a fascinating conversation. We're still waiting again for that to shake out. It'll be interesting what kind of precedent that they actually set. Bloomberg Markets Live executive editor Mark Cudmore, we thank you so much. You get more from him and the team. Just type in MLIVGO on your Bloomberg terminal. Let's go from the macro to the micro. Joe Easton standing by with our stocks to watch. Joe.
Morning, Kriti. So we're waiting to see the impact of this Boeing strike. Remember, workers over in Seattle are actually going to go on strike very soon, in a few moments at midnight time locally. And therefore, we're looking at what stocks could be affected here in Europe. For the first place to start, really, is the competitive rivalry with Airbus. We can see on the screen Boeing already massively underperforming Airbus over the past year or so, given the production issues there. Airbus pretty much steady as it goes in terms of orders. So that could be in focus. Then we're also going to look at the suppliers and customers. So here's some of the big suppliers: Safran in France, Rolls-Royce, Leonardo in Italy, and also Senior in the UK, one that's really dependent on orders from Boeing. So all of those suppliers potentially going to be in focus today. And also, of course, the airlines. Ryanair really dependent on Boeing planes at the moment. We did actually see Ryanair shares dropping yesterday on yet more comments around weakening fares from the CEO. So that could really be a focus as well today. Then we're also looking at software this morning. A couple of contrasting fortunes out of the US in terms of earnings. So we had Adobe dropping after results, weakness in some of their AI software, according to analysts. So that one down 9% at the post-market close. And Oracle going the other way, jumping amid a boom in some of their cloud software. So two things in terms of the earnings reports to watch, and the firms to keep an eye on in Europe. It's the usual suspects: SAP in Germany, Sage in London, Dassault Systems and Capgem in France. Those are the ones to keep an eye on. Will we see a bit of a read across in the tech space today? Then we've got another really interesting broker move, something you don't see too much, but we've actually had two this week. AstraZeneca down to sell at Deutsche Bank. We saw Nordea Bank do the same thing earlier this week. Now, bear in mind, Astra had some weak lung cancer drug data that we covered a few days ago, and this is why Deutsche Bank is cutting the stock. They say the drug, known as Dato, is a key building block of the single-digit revenue guidance that the company has given, and that now looks in question, according to Deutsche Bank. So they recommend selling the stock. There are now 3 sells on at that company, still 23 buys, but as I say, you can see really rare for this stock to get sell ratings. We have seen the shares decline a bit following that data, but it looks like a very small blip on the screen there. We can see over 5 years up 75%, maybe the rally coming to potentially a bit of an end. 3 sell ratings now on AstraZeneca in London.
Joe, thank you very much. Our equities reporter Joe Easton with that briefing on stocks to watch. DSV, another one to add in the logistics space. It's agreed to buy Deutsche Bahn's logistics unit at a value of 14.3 billion euros. That's a private business, so it's a big deal. So we'll watch DSV. Not expecting it to move perhaps a huge amount, given it's the acquirer, but we'll see. This
is the business that Maersk was looking at as well and walked away from. So this has been a business that's been in play for a while. You were flagging as well that Deutsche is also downgrading Roche So we're seeing maybe a kind of an issue potentially emerging today in the healthcare sector. We'll keep an eye on what is happening there. Futures, though, fairly flat at the moment. We're not going to see a big move. Bit of volatility yesterday afternoon, though.
There's another one we should mention, at least for the open, is Vodafone and the 3M merger. The UK CMA pushing out for it. They're saying, look, we're not going to give a final decision until the end of the year, but it's something that could move the stock, given that Vodafone's dealing with regulatory scrutiny on both sides of the English Channel.
Yeah, absolutely. And obviously the rivals in the sector will be pushing back against we'll want to keep pushing back against the potential for this deal. Keeping an eye on commodities and basic resource stocks, best performing sector yesterday in the European session. We see a bit of a mixed picture when it comes to commodities going into this session, so we might see a bit of retracement there. But iron ore prices down by 2.5% over in the Asia session, and a lot of people talking about, we dropped through 100, we're heading down to 90 on iron ore.
So uranium is an issue that the mining sector has been focused on over the last 24 hours. Hints from Putin that maybe there'll be restrictions on exports driving in the Asian session a lot of the miners sharply higher as a result of potential export restrictions coming out of Russia, which obviously is going to affect the United States and Europe less, Asia significantly more.
This is interesting that this is now showing up in markets and being priced in to some extent, at least in the Asian session, because this has been an overhang, I would argue, in the markets, but not something people are actively trading on the way they did, say, 2 years ago on the onset of this war in terms of retuned commodities. Do we see a repeat of that? For now, of course, we'll keep all of our eyes on, I'm going to get that word right, especially with FTSE 100, keeping a focus on the miners, keeping a focus on the commodity sector, not to mention the slew of UK stories as well. Futures in the green. The opening trade is next. This is Bloomberg.
Friday the 13th. A couple of minutes to go until the equity market session is upon us. It is Friday the 13th. Who knows what's going to happen? Yesterday, not much action for European equities. All the action was after the close here in Europe. We closed pretty much flat, as you can see on the white line. Then we got data out of the States, PPI. Then we got the Wall Street Journal article. All of these factoring into a session that saw equity markets rallying. In terms of what that means for futures this morning, Kriti, a little bit of upside.
I feel like you're jinxing it with the Friday the 13th, just so you can get some action at the opening trade. But at the moment, you're not getting that, to your point about the futures. When you look at the FTSE 100, when you look at NASDAQ 100 futures, flat on the session. To your point, some slight outperformance in Eurostoxx 50 futures, but something tells me there's a little bit more excitement underneath the hood, Anna, with those individual stocks.
Yeah, absolutely. We'll watch for any read across, certainly from the Boeing news. So Boeing Machinists voting to strike. We don't know how long that will last and therefore how big the impact will be. But certainly any customers of Boeing here in the European session, we could see some nervousness if they've got plans to take aircraft. But even if you're not a customer of Boeing, there could be some nervousness within the sector. We'll see what impact that has in the short and the long term, because we've talked to Airbus customers who've said, look, we want optionality, and so we don't like it when Boeing is out of the running. Astrazeneca in focus. They got a downgrade a few days ago from Nordea, another downgrade Joe Easton was talking about today, so we'll certainly keep an eye on that one. We also have some news around DSV. So this is the Danish logistics business. It's agreed to buy Deutsche Bahn's logistics unit. They beat CVC in the race to acquire this business. DB Schenker we're talking about here, the private business, and it turns the Danish firm into the world's largest freight forwarder, so certainly one that we will continue to watch, Guy.
OK, here we go, the Friday session. Friday the 13th. I'm going to point that out once again. We are expecting a little bit of a tick higher in the session today. The debate really around central bank rate cuts is one that we are watching carefully. But there's a bunch of single stocks, as Anna says, that may have an impact this morning. But we're expecting a fairly flat open. That is largely what we are getting. The FTSE 100 is out of the gate. A little bit of green on the screen, but not much. Keep an eye on what is happening with the mining sector, but also what is happening in the healthcare space this morning. Deutsche Bank out with a series of ratings downgrades that could affect names from Roche to AstraZeneca. The stock 600 is up by 0.2%, but the FTSE 100 looks like it's struggling in and out of positive and negative territory. The IBEX is up by 0.2%. We'll see how Germany opens in just a moment. The CAC 40, as with other markets here in Europe, not on an index level, delivering very much. But Kriti, you promised action below the surface. What are we seeing?
It seems to be concentrated on the downside in AstraZeneca, and that seems to be your biggest index weight when we're talking about that, of course, coming from perhaps the downgrade you saw in the ADR specifically. Anna was mentioning that as well. Remember, you also have a downgrade over in Roche, getting cut to a sell over, I believe, at Deutsche Bank as well. So you're going to see biotech seemingly under pressure, and surprise, surprise, that's exactly where you're seeing the underperformance. You're also seeing it in travel and leisure companies, Anna, when you look at some of the downside moves. Besides that, marginal moves to the upside. That Friday feeling showing up in the stock market this morning.
Yeah, just delving into the travel and leisure to see. There we go. Ryanair is the one that is down the most. We're talking about a move of 0.9%, so not huge.
There was a move yesterday. So it was the AGM yesterday. O'Leary's out talking about the fact that we're going to see a downside on fares of 10% in the winter, which is kind of pushing. He was a bit equivocal last time I spoke to him, but he was definitely pushing at the AGM yesterday the downside on that fare story. Now he's got to deal with the Boeing strike as well.
So there's a lot, yeah, so we're certainly looking for any read across there. We do seem to see a bit of it. Then it's the Boeing story, but it's other things as well then perhaps in the mix when it comes to Ryanair. At the top of the pile, in terms of those sectors, we've got financial services, but that seems to be a fairly mixed bag of names and not one with a huge amount of news flow behind them, perhaps. It's an interesting day, isn't it? We're always waiting for something, waiting for clarity next week, I suppose, on the 25 or 50 debate.
Can we talk about this kind of diversion that you're seeing in the pharma space, really? Roche and Novo Nordisk seem to be the outperformers this morning, despite Roche getting cut, of course, over at Deutsche Bank. Astrazeneca is taking the hit. I don't know if we can put Sanofi.
So Sanofi, so GSK, they're all down.
They're all down, but then you have some outperformers. So I'm struggling to find what is the decisive factor in the biotech space right now. It's a tale of two pharma, perhaps.
Well, the healthcare sector as a whole is up, as are most sectors.
The market likes the DSV story. So it looks like the market seems to be that it's getting quite a good deal there. The stock's up by 3%.
Another example of an acquirer going higher. That's an interesting mindset that the market seems to have adapted in a number of different sectors in September.
Yeah, because we saw that in Unicredit with Commerzbank yesterday as well. I also wonder if complacency is a part of it. We've been keeping our eye on Vodafone shares as well, given the UK CMA provisional findings as well. Those shares also higher by 0.4% this morning. Again.
Rolls is down, Safran is down, Airbus is down. So there is a Boeing effect that appears in the market as well this morning as we get news on that strike. In fact, 8 o'clock means midnight in Seattle, which means that the union has just walked off the line at Boeing at a number of different facilities. I think 33 gates are going to be seeing action this morning. They've been preparing for this strike action, so we're going to see lines at a number of different locations up and down the coast over in the United States.
So as we await updates on that situation, let's go right back to the macro, because there's plenty going on, of course, in the last 24 hours. The debate of whether 50 should or actually be back on the table, and what are the conditions that maybe support that? Mohammed El-Arian, our Bloomberg opinion columnist, weighs in. Take a listen.
We have a major reconciliation in our future. We have the Treasury part of the fixed income market that is signaling quite a high probability of recession. We have the credit part of the fixed income market that is signaling a very high probability of a soft landing. Now, if liquidity doesn't reconcile these two things, there's going to be even more volatility in this marketplace. And at some point, volatility spills back to the real economy.
Let's stick with that topic. Madeline Ronner joins us this morning, portfolio manager over at the global equities team at DWS. Madeline, a pleasure to have you on the program. Let's pick up on that concept of volatility. This morning feels a little bit lackluster on the surface. We're seeing more volatility underneath. But if there's a conversation on the macro front of 50 or 25 or a volatile easing cycle than perhaps the economy has been used to in the last couple of decades, how does that show up in the markets?
So I think volatility generally will continue over the next few months, where we struggle with this. Okay, will it be a recession? Will it not be a recession? How will the Fed react and handle this? I actually think 25 basis points would be better. So if we get more into a gradual easing cycle, that signals more to me that it's just inflation under control and less worries about the economy, because that is in the end, I think, what matters most to stock markets. Like, why are the rate cuts happening? Is it because the economy is too weak and it's supporting, or is it because we have conviction that inflation is fought? And I think a more gradual easing cycle is more what signals that, okay, it's inflation that's gradually coming down. We feel comfortable with that, and we're moving in a very controlled manner back to a more lower target rate.
Well, Madeline, we keep hearing this a couple of buzzwords here. We hear volatility, we hear uncertainty, we hear geopolitical and election risk, not to mention what's happening specifically over in the States. And I'm curious what the hedge is against all that, as opposed to just waiting on the sidelines and having a more cautious approach.
So I think one thing because investors can position is more on the defensive side. So what we have seen already since July about this year, that defensive names like in healthcare and utilities, for example, they have started to perform better. And also I would expect that to continue at least until the election. So I think that's a way to position yourself on the equity side.
Can I ask about where you see the best opportunities at this point, Madeleine, in terms of growth? Because you talk in your notes about China. You can't rely on China. It's unlikely that China will help the world economy, you say. So therefore, focus on the US consumer. So what kind of pivots out of what and into what, in terms of sectors or stocks, do you do if that's your view of where we go from here?
So I think you have to balance really, okay, where do you see the most growth and where valuations are really attractive, right? Because the market has kind of fled into the areas where you still see good growth momentum, and so valuations there are really high. So what we like is kind of the balance of both things. So for example, we still like the European stock market simply because valuations are much more attractive. We see earnings growth coming back here over the next 2 years. We see actually earnings growth from the Magnificent Seven and from the US as well as Europe coming closer together, which should help performance. So this is something that we like. So growth in general, yes, you mentioned it. So the focus is really much on what the US consumer is doing. So China is this time not helping. I think this is really a regime shift from other times of economic weaknesses that we have seen, where really China was always helping because they were just growing so much. They were helping the global economy. This time that's unlikely to happen because they themselves are so weak. So we see that with steels. We see that with EVs, for example. They're even trying to export that to a weaker global market. We see the oil print yesterday also. Where you had like the fourth decline, year-over-year decline in China oil demand. So that's really weak. Europe on its own will likely not lead the recovery. So it's really dependent on what the US consumer does. So also what happens next week with retail data, I think is really, really important for the market. And that's where you see the most growth, but valuation there also a little bit stretched. So
OK, and we'll watch the UMISH number later on today as well, with that in mind. So, do you get excited about banks, Madeleine, at this point, and the European banks and the possibility of consolidation there? Is that a theme that you are looking at closely?
Yes, so we've liked European banks actually for the course over the last year, and we continue to like them still even into the easing cycle because we think just with the hedges that they have, if it's a gradual easing cycle that's not too fast, they're still relatively well positioned. With regards to consolidation, I also think, I mean, obviously in the German market there is more room for consolidation. I think generally with regards to a European banking union, also cross-border consolidation is something that's very interesting. So let's see how this progress shapes out. I think it's very interesting what's happening there currently. I find it really hard to believe that the German government was really caught that off guard by this. I mean, for once, when the pricing came, you really had no discount, even though there was the departure of the CEO announcement. So that was really unusual, where you would usually have like a large buyer. And then on top of that, I mean, he was on an interview yesterday here. A 9% equity stake in itself is quite punitive on capital requirements for UniCredit. So I don't think that it's very likely they will just want to keep that stake. So the move really here, what they want to do is quite obvious, even if they wanted to keep all options open, or he wanted to keep all options open in the interview. But I think that's where the direction is headed, and we've not heard yet officially what the German government is thinking. But he also said what I thought was quite interesting, that he would not have made this move if he thought that the German government would be opposed to it. So it will be really interesting to see what happens there going forward. We had some other banks also prior to that already be interested in a potential deal here. But obviously, UniCredit is now in a pole position. So it will be really interesting how this shapes over the course of the next month.
Madeleine, if I want to buy Europe, if I think Europe is a place to be right now and it's going to close the valuation gap with the United States, do I need to see Europe acting in unison on things like cross-border deals in the banking sector, in finding new ways to deliver funding, to deliver the green agenda, to deliver the kind of growth story that Europe so desperately needs? I'm trying to reconcile the kind of the economic story and the political story, and what Draghi said and what is happening in Germany with the politics and what's happening in France with the politics. I'm trying to make a compelling case for why you want to buy Europe, and how much of that is built on the foundation that Europe is going to act in concert rather than as a bunch of single entities, i.e. single states.
Yeah, so I think if Europe would manage to act in unison and implement some of the policies that Draghi proposed, I think that would actually be additional upside, because then the European economy in itself would be better, right? But why we like European equities is more because, I mean, a lot of the European stock companies, they're not that dependent on Europe itself. They're global companies. They're tied to the global equity risk premia, right? So if we go into the recession, obviously, you would not want to own Europe. That's not our base case. Our base case is actually also in the US, that risk of a recession is there, but we will have a soft landing. And in that case, European stock markets are really tied to that global risk premium as well, and growth and EPS growth as well. So I think if we manage to get some policy reforms within Europe to act in more unison, to have better funding, to also do some structural reforms with regards to policies and like companies to ease more quickly, to have more innovation, I think that would actually be additional upside. So we are coming more from the angle, you have solid earnings growth, not phenomenal earnings growth, but solid earnings growth from the global side already. And on top of that, you have more attractive valuations.
Is the dismal China story in the price enough in Europe? Is it priced into the auto sector significantly? Is it priced into the luxury sector? Are we seeing enough of a hit from China to make us believe that actually, if China continues with its dismal growth story, Europe has already factored that into its equity prices?
I think so. I think that's factored into valuation. So if you look at how the European equity market traded over the last 2 or 3 years, so the discount really increased disproportionately. It's now trading on a forward PE on a 60% discount. So that's quite a bit. And I think a lot of that is due to the weaker China environment. And obviously that China historically has been a growth driver for Europe, and that's now just weakening. From a stock selection basis, yes. So companies that have been really dependent on the Chinese consumer, I think they will have tougher times ahead. I think they will have to seek out new growth opportunities in different end markets, because while I don't think it will get much worse from here, we have the Chinese Consumer Confidence Index now approaching the lows from the pandemic. So I don't think it will get much worse from here, but I don't see it getting better quickly either. So still cautious on large China exposure, and obviously on the automobile industry, we've heard more negative news flow recently too. Some of that is structural, some of that is tied to the EV transition, to China demand and all of the tariff dispute that we have there as a European Union with China. And some of that is just more temporary issues with the brakes, for example. So that's two different angles, but also difficult environment for the automobile industry here.
Interesting to hear Olli Rehn talking this morning about how concerned they are that actually more of the growth issue in Europe is structural rather than cyclical. Madeline, thank you very much indeed. Madeline Rohner, portfolio manager on the global equities team, joining us from DWS. Let's take a look at the core six here in Europe. What are we watching? What are we seeing? These are the numbers, as you can see, broadly positive. But if you actually take a look at how positive we are seeing these numbers, it's a fairly mixed picture. The luxury sector is a little bit more positive this morning. There's a really mixed picture within the healthcare sector. Novo is up very strongly, but you are seeing Astra under significant pressure. Chip stocks elsewhere a little bit more muted. Nestle up by 0.2%. There's significant M&A in the markets. There is a rating story in the market this morning. Let's get the details with Joe Easton.
We want to actually take a look at the payment processing sector first, because we've got a big profit warning over in France this morning out of Worldline, and that stock getting absolutely hammered in Paris, down 14%. At the moment, they've announced that their CEO is stepping down as well, and they've halved their organic growth guidance for the year ahead. A big shock for that company today. It has had its own restructuring issues as well, but we're seeing a bit of a recross coming through into some of the other payment processors as well. So the likes of Nexi over in Italy down 3%. Adyen not doing too badly, but clearly a move in Nexi as well. That shock profit warning from Worldline having a pretty big impact today. Then we'll check in on those Boeing affected stocks that we flagged earlier today. Airbus, not too bad, up down around 0.2% at the moment. Safran, unchanged at the moment. But the one standing out is Senior PLC here in London. Now, bear in mind, this is a company that's only got a market cap of around £600 million, but it is really dependent on Boeing, and therefore that stock down 4.4% at the moment. That was one of the worst performers in the UK as those Boeing workers go on strike moments ago over in Seattle. Then in terms of software, difficult one to read given we had Adobe and Oracle going in separate directions in terms of the post-market moves after their earnings results. Actually some green on the screen, not doing too badly, maybe feeding it through from the US overnight with potential focus on the Fed and easing, that kind of thing. So tech doing okay today. Capgem up around 0.7%. Down in Paris at the moment. Then in terms of deals, a couple of things that you've been flagging on the show already. Vodafone, there is that news of the CMA looking at that deal with Three Mobile, saying that in fact it could lead to higher prices for some customers. The company is actually saying they kind of agree with some of the comments from the CMA, so they're going to try and address that. So the stock pretty heavy for that one. DSV up another 2%, pretty impressive. It was up 10% yesterday on reports of that massive logistic deal going through, about 14 billion euros in terms of value, up another 2% for that stock over in Copenhagen. Then back to the ratings changes. We mentioned earlier Astrazeneca, and that one is declining as Deutsche Bank cuts to sell following that weak lung cancer drug data earlier this week. So it's now got 3 sell ratings, down 1.6% in London. And just to touch on Roche, Deutsche Bank did cut that one as well, but going the other way, Bank of America, they've upgraded Roche this morning. Bank of America says that concerns around the obesity drug portfolio are actually overdone. The weight on that stock is overdone because the core oncology profile is still really strong for that company. So that one actually rising 1.5% in Switzerland today.
Joe, thank you very much. Joe Easton from our equities team. We heard a lot from the ECB yesterday. We're still hearing a bit from the ECB this morning. The French Central Bank Governor Villeroy making comments about inflation, sounding a little bit dovish, saying that we must be attentive to the risks of undershooting the target. The pace of ECB rate cuts has to be highly pragmatic, he goes on to say. But yes, they should continue their gradual approach. I mean, we heard a lot from the ECB, but really Christine Lagarde not wanting to commit on any future policy moves. I
kind of hope they were always highly pragmatic, but anyway, we'll park that one. Within the last few minutes, Boeing's biggest union has gone on strike. The latest next, we'll talk about the impact not only in the United States but around the world, particularly the impact here in Europe. That's next. This is Bloomberg.
This is about respect, this is about addressing the past, and this is about fighting for our future. Our members rejected the contract by 94.6%.
John Holden, the leader of Boeing's largest union, speaking a few hours ago, this after confirming that the union will commence strike action. It has now done so at a number of different plants up and down the West Coast in the United States. 33,000 workers are going on strike. The decision comes as the plane maker, of course, struggles to recover from a series of manufacturing missteps. Let's talk to Bloomberg aviation reporter Danny Lee about what is happening here. Danny, let's talk about what Kelly Ortberg does next, and he's the new CEO of Boeing. How quickly can Boeing and the union get round the table again, get a new deal out to the union that the union members are going to accept? Because Boeing can ill afford this to carry on for much longer.
Yeah, that's right. I mean, this is a new low for Boeing, considering all the things that have happened to it over the past several months, and the fact that Kelly Ortberg was brought in to fix all the issues that are piling up for Boeing. This is going to be a true test of his resolve, his ability to show that for the board who hired him, how quickly he can fix things, because he had a strong track record at his previous company. So what can he do to perhaps personally intervene and knock some sense into the previous negotiating talks to see what more can Boeing offer, frankly. The 25% over 4 years, clearly not enough for the workers, particularly the fact that their annual bonus was being taken away. So there is a lot of anger there when you look at the strength of the results and the rejection of the deal that Boeing put on offer here. And I'm sure for Kelly Ortberg, there'll be a lot of concern, not just from the workers who are looking for a new deal, a new settlement, but also for the airline customers who will now not get their planes perhaps as soon as they wanted to, already delayed. And we've already seen frustration from the likes of the biggest customers like Ryanair, saying that they're all not having enough certainty of what kind of planes they'll get and when. So clearly there'll be pressure building on multiple fronts here, and that's just on the commercial aviation side.
Danny, 19% of Boeing's workforce represented by this union. You mentioned that 25%. They were asking for 40. It doesn't sound like they're getting close to a deal. What does that time horizon look like?
Well, this is going to be fascinating to see how quickly Boeing is willing to bring forward more proposals. And its tone in its statement only a few hours ago, it seemed open to finding a resolution, a path forward. And clearly from the union side, they are very, very clear from the union head that there was many parts of the deal on offer originally that were not acceptable. So I think clearly it's going to be critical just to see what is put forward quickly. But a twist to this earlier, the announcement was the union filed an Unfair Labour Practices Act. So this will go to federal arbitration. And so what this means is this will become a more long, drawn-out process. This is something that Boeing doesn't want because ultimately the last time it struck in, the union struck in 2018, that cost $1.5 billion a month. And clearly with Boeing's finances being much more fragile, they would rather not see a higher cash burn at this time.
Yeah, talking of fragile finances then, Danny, this is a business with a fairly heavy debt load and it's watching its debt rating very carefully. That's got to be a worry.
Yeah, no, absolutely. And given what we have seen, the fact that right now production stops on its commercial jets, commercial aviation, the revenue that accounts annually is around 40 to 45%. So with all the production that will stop from that, the impact, how much that builds in terms of pressure, the fact that it will not have cash coming in from all the planes it is supposed to deliver. Yes, there'll be a backlog going forward, but they'll be losing time and losing money from the targets that they had tried to strive to hit. So therefore, the pressure that builds will be enormous.
Danny, this clearly will have an impact at Boeing's factories, but it'll also have an impact on the supply chain. The supply chain's been so important to this industry over the last few years and the struggles that we've seen within it. Talk us about how this will ripple through the global economy.
Well, I think for the airlines in particular who have anticipated these delivery of Boeing planes, which are already delayed, it hurts, at least on the travel front, the fact that airlines can't grow as much as they want to, as quickly as they want. I think there is a frustration from the supply chain side that a key component of what they do to build, to deliver to Boeing, that may now stop. But we're in the early days here. If we find a resolution in maybe a week or two, that's a lot better than the 50-odd days that it took in 2018. So clearly the time is ticking on getting something resolved a lot quicker.
Danny, great stuff. Thank you very much indeed. Some great coverage coming out of the aviation team here at Bloomberg on this Boeing strike. Danny Lee joining us on that story. Coming up, Ralph Stein is going to be joining us, Evercore Chairman Emeritus and BlackRock co-founder. Lots to discuss. Politics, the economy, what's happening with deal flow, all of that on the table next with Ralph. This is Bloomberg.
This is the opening trader at 30 minutes into today's session across Europe. You are seeing green on the screen, and you're seeing some momentum pick up, Anna. You're higher by 0.6% on the Euro Stoxx 50. The FTSE 100 still lagging a little bit. The biotech story, Astrazeneca, certainly weighing on that market. But across the continent, green on the screen, some outperformance actually in the DAX, higher by 0.7%.
OK, so some gains across European stocks. Let's pivot to the US economy right now and get some perspective there. Wilbur Ross, the former US Commerce Secretary under Donald Trump, told Bloomberg where he thinks the US economy is heading.
I think the U.S. is heading toward probably a very mild recessionary period. And that shouldn't be too surprising. It was artificially propped up by all the rate situations that had prevailed and all the cash that was pumped into the economy in the aftermath of COVID. I think they overdid that.
As Wilbur Ross, former US Secretary of Commerce under Donald Trump's first administration, they're talking about a very mild recessionary period. That's his expectation. Let's get another perspective on the US economy and on markets, on deals and much beyond. We're pleased to say we're joined by Ralph Schloss, Evercore Chairman Emeritus and BlackRock co-founder. Ralph, really nice to see you this morning. Welcome to the studio. Thanks very much for joining us. Let's start with your sort of in-the-moment market expectations. There's a lot of people wondering whether we're going to get a cut of 25, 50 basis points from the Fed next week. Seems to matter. I wonder if, in the grand scheme of things, that's the sort of thing that matters to you because of the signalling it might give to markets. What are you thinking?
I do think it does matter. And if I were in the room, I would actually be pushing for a 50 basis point rather than a 25 basis point cut, not because I think the economy is on the verge of recession, but I think the balance of risks has shifted from a risk that inflation doesn't come down as we hope to a risk that unemployment and grows up faster than we would hope, and employment doesn't grow as fast as we would hope. And as a result, I think the argument for moving toward neutral is a pretty strong one.
OK, so you're in the 50 camp.
Yes.
Would that be, would a 50...
I'm not saying they'll do that.
Sure.
I'm saying that's what I think they should do. Yes.
So if we... is there a danger, though, that if they did 50, that spooks the horses? Would this be taken as risk on or risk off, do you think, by markets?
I think I believe the right thing to do is 50 for two reasons. One, I think the balance of risks are more in the slower employment growth. And second, we're quite a ways away from neutral. The risks, even if they are balanced, we should be closer to neutral. And I think a path which starts at 50 rather than one that goes 25 and then 50 actually communicates a more relaxed view about how the economy is doing right now. Whereas if you started at 25 and then in November did 50, it would actually spook the market a little bit.
Good morning, Ralph. So just listening to that, you're fairly confident that a 50 would not signal that we're in a hard landing?
No. I think, we're so far, obviously when we were at 0, we were a long way from neutral.
Yep.
At 5.25 to 5.5, we're also a long way from neutral. And if the risks of slower employment and inflation are roughly balanced, we should be closer to neutral. And to me, the statement should be we now have balanced risks. If anything, we have a little more risk that employment is going to grow too slowly, and therefore we should be getting on with the path, getting to neutral.
Just to break it down a little bit, which bits of the US economy do you think need rate cuts right now? Is it the private sector? I look at company margins. They look fantastic still. Really good. Is it the employment story? Or is it the government that needs a rate cut right now?
Well, the government benefits from a rate cut, but the parts that I think need a rate cut are the rate-sensitive sectors like housing and smaller business where all of their borrowing is tied to short rates, prime, lines of credit, et cetera. And so, and by the, big business is doing great. Margins are high, top line growth is decent. So I don't think the case is, in the S&P 500 or the Dow Jones. The case is in the part of the economy that actually generates the vast majority of new jobs.
How much of that strength, though, is at the whim of what might happen in the political space in the next 6 months? I'm curious, if we're talking about these interest rate cuts and this resilience, how much should the Fed be thinking about the continuity or the potential increase of tariffs in the next 6 months?
Well, the Fed would always say that they react to the economy, not to fiscal policy or to trade policy. And I think that's basically true. I think we're we're in a period right now of significant economic uncertainty. We're in this transition period from when inflation was too high and it's now coming down. It hasn't quite reached the Fed's target yet, but it's certainly moving in that direction. And unemployment is drifting upward. And, as you just heard from the former Commerce Secretary, there certainly is, some risk that we will have not a soft landing, but a mild recession. All of that means there's uncertainty. The political period adds additional uncertainty, and so that's kind of a chilling effect on significant moves by business.
Well, Ralph, famously in 2019, Jay Powell basically announced an insurance cut to address the pain from tariffs, which is why I'm wondering if that playbook sees a little bit of a repeat, and if tariffs are even something the market and the economy has gotten used to, or maybe is the budget perhaps the bigger worry?
Well, I think you have to separate what I would call trade balancing or tactical or targeted tariffs and blanket tariffs. Blanket tariffs, I think, presage, and high tariffs presage a period of declining free trade, which we've already entered somewhat. And that is inflationary and very bad for markets. So if that happened, I think we'd certainly see an effect in the markets. The impact in the economy would be, always uncertain.
Well, we're already seeing, you mentioned the difference in blanket tariffs and target tariffs. We're already seeing that kind of a continuation of not just the Trump era, but even in the Biden era, a continuation of tariffs, not just on China, but on Europe as well. At what point is that so damaging to the economy?
Well, the magnitude of them has not been that great so far. And I think as a general matter, the Biden administration has tried to balance, what they would call fair trade and, a reasonable relationship with Europe and our allies in Asia, and not a whole-scale attack on free trade. Being the special trade representative in the Biden administration has probably not been the most exciting job over the last 4 years.
Yeah, maybe. Let's talk about areas of the market that might be exciting and talk about deals, because that's something I'm sure you have views on. We're just seeing another example this morning. Digital Bridge set away the sale of a $4 billion firm EdgePoint. Just another example of maybe some deals going through. We heard from Barclays this week, Goldman Sachs this week, both saying things are starting to pick up on the deals front. Wishful thinking or actually seeing evidence of that?
Well, there's definitely some pickup in the announced activity. If you look at the first 8 months or so of this year, the dollar volume of announced transactions is up. Interestingly enough, the number of transactions is still down this year. There's, if I look at Evercore's business, we track a number of indicators. The least forward-looking is our backlog, which is, tangible. The other measurable ones are new engagement letters signed. Earlier than that is new conflicts clearance, when a client calls us up and says, hey, we're thinking of this, will you help us? And even earlier than that, which is not quantifiable, is active dialogue with our clients. The active dialogue with the clients is way up. New engagement letters is up. And conflicts clearances are up somewhere in between those two. So there's definitely a significant amount of pent-up activity. As we talked earlier, we're in a period of economic uncertainty. Economic uncertainty is the enemy of announced activity. So it's going to happen. It's a question of when it really starts.
Do you think the Harris camp is generating economic uncertainty? We don't know yet what the Harris camp is going to deliver in terms of its economic agenda. We seem to be light on detail. What is your sense of that?
Well, I'm not sure if I had a scale here and I watched the debate on Tuesday night, which I did at 2 a.m., that if going down was on the one side was how specific was the candidate in terms of their economic policy, I'm not sure that the Trump side would go down more than the Harris side. So I think that, you know, both of them are trying to say as little specifically that so that they don't offend anyone. I actually think she's been more specific than he has, at least in the last, you know, since she's entered the race. So I think the fact that these are two very different visions for America definitely, and it's a toss-up, definitely injects uncertainty. But I wouldn't put her policy as being a principal contributor to that uncertainty.
Well, you talk about her specifics. Her campaign has certainly outlined, as she has as well, in terms of a continuation of the Biden policy, which is tackling drug pricing. She's talked about grocery prices, housing affordability. Economists and investors would listen to that and hear that and be concerned about that being a recipe for stagflation. Do you agree?
No, I don't. I think that there are two elements to her policy. And by the way, I am a Democrat, so take this all with a grain of salt. I think there are two elements to her policy. One, it's a torque the benefits of our society a little bit toward the middle class and those less privileged. And I think her policies on housing affordability, drug prices, child care, and the child tax credit all are geared there. And you know, there's going to be a massive debate next year about the extension of the Trump tax cuts. And I think the biggest difference between these two is the position that they will take on that, whereas Trump is for extending all of them and for, in fact, expanding some of them on the corporate side. And she is clearly for expanding all of them for those below $400,000 in income and cutting back on the corporate side. She's proposed 28% rather than 21%, and probably eliminating some of the cuts that are beneficial to the most wealthy in our society. I think it's a policy focused on a little bit of retorquing toward the middle class and below, and a growth agenda.
The counter argument of that simply would be that the Trump tax cuts did great for the economy. Jamie Dimon has made that point. A conversation for another time. Ralph Schlosson, we have to leave it there. Evercore Chairman Emeritus and BlackRock co-founder. We thank you so much for joining the program. Coming up, we go right back to the deal space. Ralph was talking about that as well. This time in the UK, two major Vodafone deals are under regulatory scrutiny in the UK and Italy. The company's CEO of European markets joins the program next. Stick with us. This is Bloomberg.
Welcome back to the opening trade. Let's dive into some news around deals this morning. The UK's antitrust watchdog says the Vodafone-Three deal raises serious competition concerns and says it risks harming consumers. We're joined now by Vodafone's CEO of European markets, Ahmed Essam, who has been overseeing, from a Vodafone perspective, the merger. Ahmed, really nice to speak to you. Let's dive straight in then, shall we? The CMA seems to be concerned about a number of angles here, and one of them is around pricing. What can you tell us around pricing? Any wider guarantees you can offer the CMA on that front, especially as you're going to have to do a lot of investment to improve the network, and that might assume increased prices. What can you tell us on the pricing front?
So good morning, Anna, and thank you for giving me the time to speak to you today. So it's important really to speak about what sits at the heart of this deal. And what sits at the heart of this deal is a once-in-a-lifetime opportunity to really transform the digital infrastructure of the UK. We will invest 11 billion of our own money to make sure that we build the best mobile network in the UK. This includes bringing 5G to every town, village, school, hospital across the entire length and breadth of the UK. We worked closely with the CMA over the previous period. And it's important to say that what comes out in this report is provisional findings, meaning we still have next steps to go through as we approach a final conclusion on the 7th of December.
OK. Ahmed, are you assuming, though, that you mentioned there 11 billion you're spending, better 5G coverage, but are you assuming then that customers will pay more for that 5G coverage?
No, we completely disagree on this point in terms of pricing. We believe the market is competitive as it stands, and we believe that with this proposed merger, we will bring more competition into the market. And competition is not only based on pricing, it's also based on quality. And I think where the UK lags today is on quality, and we will address this through the merger. We believe this pro-competitive merger will drive even further competition in both the retail and the wholesale market.
So, Ahmed, it's Kriti in London. Just to confirm, are you saying that you're not planning on changing your pricing?
Yes, and we've clearly said that, Kriti. Thank you for this question. We've clearly said there is no proposed change in any of our pricing strategy. If you look at the heart of this merger, this proposed merger, it's really an investment case. It's an investment case that brings a bigger, wider infrastructure. We will have a lot of more capacity. We're more than incentivized to compete rather than take the prices up. So that's really what we believe, and that's what we've explained to the CMA. We disagree with the pricing conclusion that comes with the CMA, but also will work closely to address any of their concerns over the coming period.
Well, I mean, I'm sure you can understand the CMA's concerns that if you do control more of the infrastructure, you have more of that ability naturally to change your pricing. And I hear what you're saying and appreciate that you have no plans at the moment. But what might change that? What might change? What circumstances might change your thinking around increasing pricing?
I think the only constant that has been in our industry, and everybody would see this, is with new technologies, with new investment, what comes is a lot of capacity. And what consumers have experienced throughout the previous period is mobile accessibility has been more and more affordable over the previous years. You can expect more of this with this merger, because this merger, we made a number of commitments in this merger. The first one was the 11 billion of investment. When we make this 11 billion, we're willing to undertake a legal binding commitment to really underpin this execution in the market and deploy all the sites required. We also made another commitment of trading radio waves and spectrum to one of our competitors that will elevate the experience on their side. So there are many commitments that we've done. We're not expecting pricing to go higher. In fact, we are expecting the price to become more aggressive and more competitive post-merger, because now we have a lot of capacity. We have a bigger network. We have more of an incentive to fill it and drive more activity on it, rather than just take the prices out. That's why we disagree with the CMA on this point.
So you disagree, but how big a surprise is what we've heard from the CMA this morning? Was this largely in line with what you would have thought would have come out?
So it's a really good point. So I understand and I appreciate the point that's coming out of the CMA on pricing, and we need to work closely with them to address any of their concerns on this front. But most importantly, I think when you read the provisional findings, you will find also that the CMA acknowledges that there is a quality improvement that comes out of this merger, and this quality improvement is important for many of our customers, and we positively see this. They also see the value of the investment going into digital infrastructure that is required for the country. So there are many things that we see as positive out of this merger, and I think it's quite visible when you look to the scale of this investment. It's not every day where you get our own money going into such a big investment. There is no need for taxpayers' money to come and cover a gap later on. When you look to UK ranking today, we really trail behind the rest of Europe, and this is a once-in-a-life opportunity to get there. The concerns will be addressed over the coming period, but we expect the final conclusion on the 7th of December, and we're confident that we'll be able to work as close as we can with the CMA.
So you think you will get to a deal by December the 7th, which, as you say, is when the final deadline is. So what gets us there? What are you going to have to do? What remedies are going to have to be changed? What are you going to do to make sure that on December the 7th we are good to go?
Yes. So, as I said, I think the first commitment is on how do we make sure that the investment that we're putting in is actually going into the right places, is legally binding, and we're deploying where it matters, and we're willing to do this. The second one was on the spectrum trade or the radio waves that we're doing with one of our competitors. And then the third one will be working closely with the CMA to address their concerns and find possible solutions as outlined in the findings today. We're not. It's not right to kind of speculate now on what the solutions might be, but I'm confident we'll be able to work with this to get to this conclusion.
Ahmed, you talk a lot about the infrastructure story. One of the cases or one of the concerns from the CMA is that your case for infrastructure is overstated. What are they missing?
I think when you actually look into, and I was hearing the message from Stuart as well this morning, I think the CMA might see that we might not be willing to carry on with this investment. That's why it's really important that we underpin this with a legal binding agreement to make sure that this network investment is really going on the ground and going to be executed. So we're willing to take this commitment, and we've highlighted this previous on. I think the impact of it is really transformational, because the experience that we're seeing in the UK today is far lower than where it should be. At the far end of the plan, what we get to is more than 90% population, more than 95% population coverage of 5G standard. The coverage, there's a big part on digital divide today. There are many rural areas, rural towns, where you don't get as good coverage as you should. And we will be able, through this merger, and we've done the modeling on this, and we can show this to the CMA and Ofcom, is that this will address the entire length and breadth of the UK. We will be able to address...
Okay, Ahmed. Sorry to interrupt, but we're just coming up to a break. Ahmed, thank you very much for joining us. Ahmed Essam, putting forward Vodafone's case, of course, Vodafone's CEO of European markets. We will see how this plays out then into December, when the CMA is expected to make its final decision. We see the DSV share price is up by 1% today. Coming up on the Pulse, Francine speaks to the CEO of DSV, which just purchased Deutsche Bahn Logistics for over €14 billion. This is Bloomberg.